I have a question from Grant. Can you please tell me about the differences between a recession and a correction? I know the market has been getting hit pretty hard lately, and I'm wondering if we're looking at a possible recession. If so, how do I invest to get the best possible returns? This is an excellent question. Unless you've been living under a rock during the month of January, the stock market has been an absolute disaster. There was literally a panic selling on Monday, January 24th. Dow Jones Industrial was down about 1,000 points and then slowly recovered within the same trading day, and then it went up by 99 points. I have never seen that happen before. Well, I might have, maybe way back in the days. Nasdaq was down almost 5%, and then it ended up with 0.6% gain. And then S&P 500, as of January 24th, is down 7.5% year to date, almost in the correction territory. So if you start investing in the S&P 500 index fund on January 2nd, 2022, you're almost down 7.5%. That can be extremely discouraging for the brand new investors. So let me answer Grant's question. A correction is when an asset or industry loses a significant amount of value. So a correction could happen to a specific stock like let's say Apple, which is down 11% since the beginning of 2022. Looking at the same tech industry, Facebook is down almost 10% year to date, Amazon is down 14%, Google is down 10%, and Tesla is also down 10%. So there's no formal definition for a market correction. But just by looking at these tech stocks, you could say there's a correction in the tech industry. And if you want to know how the tech stocks are doing, just look at the Vanguard VGT ETF that focuses on the tech industry. There's a common rule of thumb when a market correction happens. When the S&P 500, Dow Jones Industrial, or Nasdaq fall by 10% from their all-time highs, then most investors would consider that a market correction when the loss is felt by over an entire stock market. A 10% drop in the S&P 500 index is a correction because stock prices are correcting themselves to the true values of these companies and their assets. Since 1971, the S&P 500 has registered a correction 65 times. And of those 65 times, 24 of them have resulted in bear markets. So a bear market is when the index declines at least 20% from a recent peak. The S&P 500 52-week high is 4,818 points. So in order for the S&P 500 index to hit the bear market, it would need to drop to about 3,854 points. A bear market is obviously more severe than a correction. If a S&P 500 does drop by 20%, then the 500 largest companies are either losing their revenues and earnings, or investors are more risk averse than risk seeking because they're predicting a weak or slowing economy. Now, there are also other factors to the bear market. There was a dot-com bubble from 2000 to 2002, which dropped by 46% during those 3 years. The collapse of the 2007-2009 housing market resulted in 38% decline in the S&P 500. The stock market crash between March and April of 2020 was a direct result of the economic shutdown because of the pandemic. There's also fears in the market due to the potential military conflict right now between Russia, Ukraine, and the US. Is there going to be a recession? I don't know. You should know that recessions are not measured by performances of the stock market. A recession is when the US economy's GDP has declined for 2 quarters or more, and unemployment rate keeps rising because companies lay off workers to reduce costs. According to Sean Williams from The Motley Fool, and there are 10 reasons the stock market could crash in 2022. I'm just gonna get into the ones I believe will happen. You can read the rest of the article, I will link in the description below. One of them is high inflation. When the price for goods and services rises rapidly, businesses and consumers usually aren't able to buy as much with their disposable income. High inflation can hurt especially to the medium to low income households. Another one is the Fed turning hawkish. So what that means is that the Fed is looking to raise interest rates at least 3 times throughout 2022 to calm down inflation. People are less likely to borrow money to make large purchases when interest rates are higher. When people spend less money, companies make less revenues and earnings, and that could result in slow economic growth and GDP. Another reason is a margin-induced meltdown. I can see this happening now that the market has been declining for quite some time. I never borrow money to buy stocks. It is very risky, even for someone like me who is very aggressive in the stock market. As of November 2021, there's $919 billion in outstanding margin debt. So people are borrowing money to buy stocks or crypto. When stocks and crypto drop in value, they get a margin call, and if they can't pay back their margin debt, they're forced to sell their stocks and crypto. That is scary, right? And one last catalyst is the stock valuation. The S&P 500 PE ratio entering 2022 was at 40, which represented a 20-year high. Historically, when the S&P 500 PE ratio is above 30, the benchmark index lost at least 20% of its value for that year. Let me answer Grant's final question. How do I invest in the market that keeps on crashing? I can't tell Grant what to do, but here's what I am doing. I am going to keep buying and holding. I am not a short-term investor or trader. I still don't care what the market does in the short term. I have a long-term vision about what the market will do 20 to 25 years from now. Most young investors haven't seen a recession or a bear market. We have been on the longest bull market in history of the stock market. And we're not going to get 15% or 27% in annualized return every single year. That would be nice, but it is highly unlikely. Let me show you this S&P 500 chart. When you look at the market in the short term, like in 2007 to 2009, if I stop investing from the market high in 2007, it would take me until the middle of 2013 to get even. Again, that's assuming if I don't dollar cost average or investing anything from 2007 to 2013. If I dollar cost average from the market high in 2007 until 2013, I would have made 23% in 2009, 12% in 2010, 13% in 2012, and almost 30% in 2013. That's almost 88% in total return between 2009 and 2013 following the global recession. These numbers aren't exact, but you get the idea. I want you to think long term. I personally know several people who completely cashed out of their investments in March and April 2020. And guess what? They completely missed out on their growth during the year of 2020 and possibly in 2021. The market looks scary right now, but I will continue to stick to the same investment strategy, and that is to buy and hold. Buy and hold.